Welcome to today's meeting of the Local Pension Committee, which is taking place in the Spark and Hoe Committee Room at County Hall, though some officers and advisors will be joining us via Microsoft Teams. This meeting is being broadcast live via YouTube, and it will be also available for viewing after the meeting. I have received apologies for Councillor Govind and Mr. Campbell. I know some members are attending on Zoom as there isn't, as is their request. So, item 1. I propose that the minutes for the meeting held on the 4th of June are taken as read, confirmed and signed. Is that agreed? Yeah, lovely. Thank you. Question times. I received no questions under question times. Questions asked by members under Standing Orders 7.3 and 7.5. I have not received any questions by members. To advise of any other items which the Chairman has decided to take as urgent elsewhere on the agenda. There are no urgent items. So the next item is declarations of interest in respect of any items on the agenda. Do any members have any interest to declare? No, I would be surprised if they did, but thank you for that. So the first item on the agenda is the funding position at the 31st of March 2021, and Ian Howe, Pension Manager, will present this item. He is joined by representatives from Hyman Robertson, the Fund Actuary. Tom Hoare and Richard Warden are also in attendance for this item. And so over to you, Ian, please.
Thank you, Chair. Good morning, everybody. I'm Ian Howe, Pensions Manager. I'm afraid I don't have a name badge, so I think I must have disappeared during COVID, I think. This report is really off the back of the training session you've just had from Hyman's. I thought it was worth having that session first to try and add some context to this report. That was the intention of that. So I hope you'll find that useful. This, excuse me, this is a position statement as at the 31st of March 21. The fund is valued every 3 years. The last valuation was the 31st of March 19. And at that point, the fund was effectively 89% funded, which broadly means that we had 89% to pay every £1 of member benefits, based on all the information we've heard about the assumptions and the risks, etc. That was on our assumptions, not the GAD assumptions, as Tom and Richard have mentioned. This statement is as at the 31st of March, and we've done this just to effectively ensure that the position we're in is positive and it's remaining positive and we're tracking in the correct direction. So this is a good position, and as Chair has already said, we're in a strong position moving forward. The mid-valuation position as at 31st of March 21 shows an improvement, and we are now 100% funded. So that's obviously a very much more positive position than we were a couple of years ago. I think without going through all the detail, I want to particularly pick out some key points within this report, if I may, though. And they are really the points in areas 10, 11, 12 and 13. And whilst all that detail is in the appendix, I just want to particularly highlight these. So the past service funding shortfall has decreased from 537 million to 15 million. And that's based on the funding target and the annual investment returns, which have an 80% likelihood of being achieved. That also still takes account of the prudency around Mcleod. So you can see that that's been a significant improvement from 537 million deficit to 15, which is effectively the 100% funding. The full funding required return at the 2019 valuation, the investment return of 4.5 was required to provide the 100% funding. At the 2021 mid-valuation, it shows 3.8% are required to meet that same 100% funding. So that's a real improvement as well, because it means we'd effectively have to hit a lower investment target to still retain that 100% funding. So that's really good. And the likelihood of the fund's assessment of achieving that level is increased from 70% to 80%. So again, that's good news. The outlook, the future outlook, is pretty much the same as Tom and Richard mentioned earlier. So that again is good. You know, it's not as though we're now aiming for a more difficult sort of future position. So that's positive. So I guess the key bit really in terms of how does that impact on the employers, because that's ultimately what the employers want to know. What am I going to be paying as an employer? What's my employer contribution rate going to mean off the back of that? Because that's really the critical part really in terms of the employer angle. Well, the employer contributions, the rates are set and there's two elements to them. There's the primary rate, which covers the cost of benefit accrual, and the secondary rate covers the cost of benefits already accrued. Now, Hyman's indicate the cost of future benefit accrual has increased, which is likely to increase the cost of the primary rate. And the likelihood of the primary rate, 20.4% of pay, meaning the future cost has actually reduced from 78% to 70%. So that isn't so strong, that isn't as good. But what Hyman's are also suggesting, the improved past service funding position will have a positive impact, which should hopefully slightly offset some of that change, if you like. So what that really means is whilst it's extremely difficult to predict with certainty what it's going to be at March 22, because things can change, as we all know, in the markets in the following year, we're kind of expecting that to pretty much mean that they're going to be pretty much level. So we don't expect, we're hoping we don't expect significant increases from employers, but as Tom and Richard said, there are differing employers within the fund and they have different risks. So we're not suggesting that no employer rates will increase, but we're hoping that it will remain a fairly stable position at the next valuation. The other points I just wanted to mention, I'm obviously happy to take questions, and Richard and Tom will equally take questions if you have further ones, and that's absolutely fine. We talked about, Richard and Tom talked about the GAD 13 report and the way that works, which is effectively trying to compare all of the funds on an equal basis. So taking away some of the fluctuations in assumptions between the funds and looking at them equally. The good news there is that we've had no flags raised within our fund. So that means we've got nothing that's coming up as a concern at national level that's a risk. So whilst the actual report isn't out until we believe October, we've got some good assurance that that's good news. The other point I just wanted to mention is the timeline, because this is important, because the timeline for any valuation always has to be set quite a long time in advance, because there's lots of steps within that valuation process. And there's various groups involved. There's ourselves as officers, there's yourselves as committee, there's clearly work with Hyman's. So what I've done is I've kind of done, it's a fairly high level timeline, but it's a timeline that we'll aim to work to. And in there, you'll see there's some things that come to committee. So in like November, we'll agree the assumptions for the 2020. We'll actually, I apologise, we'll agree the principles, I beg your pardon, for the 2022 assumptions. The 2022 in March, we'll have the results of the stabilised employers. The stabilised employers are the larger employers in the fund. They are the boroughs, the districts, the city, the county, police and fire. They're the bigger employers in the fund, or tend to be the bigger employers, and those that have tax raising ability. So we'll have those by March. Then in June next year, we'll agree the final valuation assumptions. Then there'll be lots of work ongoing, and then the key point then is really to jump ahead to January 23, where we'll bring the funding strategy statement and investment strategy statements, which are those points that Tom talked about, Richard talked about at the end, which holds all that information together. And then from April 23, the new employer contribution rates will then come into effect. And that then runs for 3 years through to March 26. So there's lots of work already taken place. There's lots of work to do, but that then sets the employer rates from April 23. I hope that's a kind of a useful summary of the report. As I say, Tom and Richard are still on the line as well, if you have any questions. So, Chair, if you're happy for me to take any questions.
That's very, very good. Thank you very much again. I mean, the way it looks at the moment, we're 3.8% funding would achieve 100% funding with an 80% likelihood, and any past, the improvement of the past service funding on the future liabilities are somewhat balanced out. But as you say, we're going ahead to try and value it again and see what liabilities and uncertainties that we need to cover in the future. It's certainly very complex, but I will open it up to any questions. Has any members got questions?
Thank you.
Sorry, Nick.
Yeah, thank you, Chair. Is it right then? I know these things are all highly complex and subject to all kinds of changes still to be sorted in, but is it true that the employer's contributions essentially will, you're saying, be the same, is that the primary rate goes up and that's offset by the fact that the secondary rate is not required to any great extent, so therefore the two match each other, so that going forward what employers will be paying in 22-23 will still be the same in 23-24, 24-25. And the other question is there possibly some scope, I'm just floating this, to aim for 105% rather than 100% to give that little bit of flexibility, perhaps for climate?
It's the first question is the critical one, and as an employer, Nick, I completely understand why you're asking, and you're not the only one. I get many of the employers asking me the same question, and quite rightly. It's really still hard to predict with any certainty, Nick, but we're hoping that it's going to be pretty even across employer rates as they currently stand. That said, some employers will still see increases and some will see decreases, Nick, to be fair as well, in all likelihood. But we don't anticipate, as it currently stands, any increases or significant increases over the coming 3 years. That's what we hope. But I always caveat that with who knows what's going to happen between now and the next valuation timeline. But that's what we're hoping as it currently stands, Nick. In terms of the 100%, 105% funding, we'd still probably aim for 100% funding, but we could increase the likelihood of getting there, Nick, I guess, is the other way of turning that around. So that's effectively giving that prudence or greater prudence, but we wouldn't necessarily be aiming for more than 100% funding, but there's more, we could aim for a higher likelihood of achieving those investments, depending, again, on what happens between now and the next valuation timeline. But that's how we'd aim for it, Nick. But that would build in the prudence you're effectively saying, Nick. Does that help?
Ian, do you want me to just add a couple of bits on that? Sorry, it's Declan.
Yes,
on
please,
the,
Declan. Thank
sorry,
you.
I'm behind you. Nick, on terms of the one thing to worth bearing in mind is this, all the stabilised employers were still on a path of increasing employer contributions. So just be a bit careful about, I suppose, messages going back to the city, because none of us had kind of reached our kind of necessary kind of secondary rate to sort of get to 100% funded. Now things have improved, but just bear that in mind that when you look at the overall fund at 100%, the stabilised employees were a little bit kind of behind in terms of getting those rates in. So just have that in the back of your mind. And the other piece is that in terms of that, obviously now we're at 100%, there are going to be some employers above it. And I suppose just as the funders being kind of kind to employers and not expecting an immediate kind of deficit reduction, when the fund goes over 100%, there is going to be a little bit of smoothing there as well to say, actually, we're not going to just hand cash back. It'll be sort of, manage repayments over a period of time just to create that stability of the overall fund as well. So that's how we like to do it, but we'll work that through in kind of, I suppose, a new set of sort of rules or guidance in the funding strategy statement.
Thanks, Declan. Have I got any other questions in the room? I have a couple online. Has anybody else got any questions in the room? No. So, Claire, if you can ask your question.
Thank you, Chair. For the newer members of the committee, my name is Claire Scott. I'm an independent advisor for the committee and the fund. My question is on the same subject, but maybe ask it in a slightly different way in terms of the primary rate. Obviously, the likelihood of that being sufficient to meet the benefits has gone down. Perhaps by thinking about that in a different way, the question is, what would be the primary rate if we try to keep the level of likelihood and confidence and level of prudence similar to what it was at the last valuation? And linked to that, obviously, you mentioned inflation, Richard, earlier in the presentation and the training session. I noticed in the report there's been no adjustment for the CPI, RPI, reform as well. So just, I think it might be helpful just to give some context. And I think, although it's great news that the funding levels improved, I think there is maybe a little bit of caution on the primary rates, perhaps.
Yeah, I think.
Thank you.
Yeah, thanks, Claire. Yeah, it's a good point. So I think 20.4 we mentioned has been the it's a whole fund primary rate at 2019. I don't have an exact figure for you. I'm also a bit nervous as well about giving an exact figure, as for the reasons that Ian stated, and I don't. But I would say it's going to lie somewhere between 20.4 and 25 at the primary rate, and I guess would be it's going to inch up by 2 or 3%. But equally, secondary rates might come down a bit, notwithstanding the comments that Declan made about stability, because it's an important thing where that stabilisation mechanism applies to the low risk employers, so the councils, etc., the kind of tax raising bodies. They're on a slightly different path because we kind of smooth out the market volatility a bit more for them, so their kind of cycle and rates is a bit different to the non-stabilised employers. But I think the general theme is, primary rate inching up by, I don't know, I'm guessing here 2 to 3% or something of that order, based on where we are perhaps currently. But secondary rates coming down as well for the non-stabilised employers. Thinking the other thing that we've kind of alluded to is surplus. The fact that it gets interesting when we get into a position where the fund is well funded and we start to get into surplus, because of course we're so used to handling and trying to get rid of deficit over the last decade or so. We're actually in quite a nice position of thinking, what do we do with surplus? Because and Declan mentioned a minute ago, do you just hand it all back? Well, that's probably not the best thing to do. You need to hold something back, and also of course that has an impact on investment strategy. Do you become a little bit more defensive? So that's another kind of theme or topic to sort of think about, I suppose, at evaluation, because we do try to reflect what we think the future investment strategy will be as well, and we can model different types of investment strategy to get an idea of what impact it has if you go a bit more defensive on the investment side. So that's something that perhaps we'll bear in mind for modelling. Probably yourself, Claire, and other investment advisors and officers get involved in that discussion and then bring that to committee to see what the impact of that would be.
Thank you, Claire. Some very good points there. I have one other question from Ashley. If Ashley is online, if you can ask your question, Ashley.
Just to make sure I've understood, you mentioned the past service costs and the contributions hopefully will remain sort of stable. Does that mean the current service costs that we get through the actuary or disclosure in the accounts, etc., does that mean that will stay relatively stable? Have I understood that correctly?
I'll let Tom answer that because he's our accounting expert at Hyman, so you're very close to the action on the accounting, Tom, aren't you?
Yeah, so it's a good question, and I appreciate a lot of employers. There's two things to consider. The valuation is obviously the foundation for everything that we do, and one of the things that fall out of that is then sort of 3 years worth of accounts, which of course is very important for a number of employers as well. So the question here is to do with an item in the disclosures called the current service cost, which is effectively the ongoing cost of accrual for an employer, and it features in the operating costs in the accounts, and it's an important figure. So yes, some of the things that Richard's talked about does have an influence on that, but less so. The current service cost will go up or down, and it's largely driven by the accounting assumptions at each accounting year end. So some of these pressures in the environment. Actually, Claire mentioned one earlier as well. RPI reform and the impact that's having on the CPI assumption. Actually, that's already part of your current service cost. That's kind of been brought in the accounting space. So oddly, some of the pressures that we're talking about for primary rates at the valuation, you might have actually already seen some of these pressures realised in this year's accounts on your current service cost. But there's other things that kind of mean that the two don't go exactly hand in hand. So it's difficult to draw a parallel.
Thank you. Thanks.
Thanks.
Do you have any further question, Ashley? No, that's fine. Okay.
No, thank you very much, Chair.
Thank you. So we have no other questions. Thanks very much, Ian, for explaining what is immensely complex subject in a very straightforward and simple way. I think we can understand it. So, committee, we're asked to note the report. Is everybody happy to note this report? Yeah. Thank you. That's unanimous. So the next item on the agenda is the Pension Fund Business Plan and Budget Update for 21-22. So I'm going to ask Bulesh to introduce this report.
Thank you, Chair. Good morning, everyone. So the purpose of this report is to update the committee on the Pension Section's business plan, which Ian Hare, my colleague, is responsible for, and also the pension fund's budget, which is a combination of investment manager costs and the authority's central costs, which Ian is also responsible for. Moving on to page 34 and point 8, talks about the current pension section's business plan. Ian, do you mind?
Thank you, Bulesh. Yeah, I just come in on this point. We produce a business plan every year, and that is taken through to the committee and the board for noting. There's the main challenges that I just wanted to kind of highlight with yourselves is the ongoing review of the pension section processes. That's primarily concentrating on member self-service, which is effectively where our fund members can go online and do their own kind of calculations. They can send information through to us. We're doing more retirement processes online, and that's a big drive for us. We've got in the region, I think, of around about, I think now it's around about 15,000 people signed up to this, so it's working well, but there's still a long way to go. We've got sort of 90,000 people in the pension fund, so there's a lot more to do. Employer risk and managing employer risk is a big area, which again also links back to the previous report and the valuation effectively as well, and what Tom and Richard were saying. We have to manage the employer risk, particularly around the smaller employers that are those that have come across from TUPEs. So if we have an organisation in the fund, so let's say, for example, the county council, and they outsource a number of staff to a private firm, those staff remain in the local government pension scheme under the TUPE reg. They move across and stay in the scheme, or can stay in the scheme. They don't have to, but they tend to stay in the scheme as the new employer. There's a risk associated with that employer, so bonds and security around those is an area that we're doing a lot of work on. And we've just literally in the last about 3 weeks purchased a new system called Epic, which is a new system for controlling employer risk and managing that. And we're actually in the process at the moment of inputting a lot of information into that, which will help us manage employer risk moving forward. So that's a big area of work that's ongoing at the moment. And the other key one I really wanted to mention, which was already been touched upon, is Mcleod. Just to give you a little bit of kind of the history of Mcleod, there was a challenge made against public service pensions being discriminatory, and it was brought about because people who were within 10 years of retirement had a greater guarantee than those that were younger, effectively, and that claim was won, and government decided after a long legal process not to pursue that any further. So what we have to do is, we were in the process of a Mcleod remedy, and this covers all public sector, it's not just local government. And effectively what we're going to have to do is review the benefits for the pensions in payment and future benefits for current members and compare the benefit based on the final salary to the career average and effectively pay the higher. So that's an enormous exercise that's ongoing, and it will mean that we're going to have to revise pensions back from around about 2012. So we've got a big exercise ongoing there. At the moment, we're uploading all the hours from the employers. The employers are submitting those to us, backdating those hours, uploading those hours in order for us to do that. So that's another huge area of work that's moving forward in the section. Do you want me to? Yeah.
Thank you, Ian. Points 9 and 10 talk about the pension fund's budget. It looks at the current year's budget for 21-22, a forecast for this year's budget for 21-22 out to March 22, and then adds on 3 years worth of forecasts out to 24-25. We've added 24-25 for the first time this year, so we've got 3 years worth of forecasts. It's probably helpful to look at the table on page 35. It splits out costs for the fund into 3 sections. So investment management expenses, which further subdivide into 3 sections. So that's management fees we pay our underlying managers, the transaction fees for them buying and selling various securities, and performance fees. Performance fees aren't paid to every manager, they're paid to certain managers for when they outperform a predetermined target. We'll touch on those a bit again later in the report because they're quite important. And we've then got a section there for LGPS Central's costs, so that's the pooling company's costs and our share of those costs. You'll see that in the middle section there, and then we've got a further section starting with staffing, followed by IT, actuarial and support costs, and they're our own authorities costs that Ian looks after. You'll notice that the overall fee in the total line there for budget is 44 million. We expect the forecast this year to be slightly higher, and it comes down to higher performance fees than we budgeted. We've had a fairly good year in the fund, and as expected, you'd expect to pay performance fees as a result. Moving over to page 36. The growing total performance fees and indeed the total costs to the fund grow as a result of the assets under management growing. So as the assets under management grow, we'd expect to pay higher fees, given investment manager fees are a percentage of assets under management. Point 12 talks about our LGPS central costs. They've come down slightly from the budget as a result of a resolution being passed to reduce the amount of markup they charge us. So we moved from 20% markup down to 10%, and that was unanimously agreed against through the 8 partner funds that own LGPS Central. As part of the forecast, we've increased the LGPS Central costs by 3% per annum on a prudent basis to kind of reflect cost inflation in running the company. Product development costs have also been reduced. So these are the costs that we pay Central for developing new products. We've reduced those year on year as a result of having fewer opportunities to pool. The poolers, all our current fund has already pooled a number of products already, and we don't see as many opportunities in the future. Sure.
Sorry, page 25, those costs are forecasted to rise every year. What is the benefit of the LGPS Central if our management costs and our performance costs and everything else are continuing to rise? I thought the whole point was to reduce these costs.
So it's a very good question. So as a percentage of the overall fund, that you'll notice the last but one line shows a reduction in fees, and also we've got an example on page 37 of fees being reduced. So we've got 4 recent examples here of transitions we've made to LGPS Central. The ones that we made with cash, obviously we can't see the benefit of the savings, because obviously cash is a nil fee, but the Ashmore EMD fund that moved to a central EMD fund saved us 55 basis points on management fees per year. So that's a fairly sizable decrease on a kind of like for like change. Similarly, we've got a passive fund that moved from LGIM to LGPS Central. That had a smaller fee saving, but that's because the old fees were relatively low to begin with. Similarly, we've got private debt, which the investment subcommittee approved last in July. We'll probably see some savings there. We'll note that Hyman's expressed satisfaction in the kind of fees that were being achieved by Central. Coming back to your original question, why we're seeing the overall fees for the fund increasing is purely because we've forecast the fund to grow by circa 5.5% a year in terms of total assets, and as that number grows, the full number should grow in line with it.
Thank you, Elise. A very relevant question. I think that probably clarified it in my mind and everyone else's, I hope. Thank you.
Moving on to point 16 is the pension sections cost summary, starting with staffing. Ian, are you able to talk about those sections?
Yeah, the pension section, we have 33 full-time, 33 equivalent members. I think the actual information on the report is actually on page 35, where it shows a sort of an increase, effectively an inflation increase for staffing year on year. In terms of IT costs, we went through a tender, and Hyman's Robertson are our system provider. So we've kind of worked with them closely, and that's the majority of our IT costs is that system. We've kind of capped that, so that's just a small increase year on year. Actuarial costs, we predict to keep them stable, no increases apart from a valuation year, which is considerably higher because of all the additional work that we have to do with the actuary during that year, which you've heard before. And then the support services, again, are just small increases for inflation. They are all detailed on the table on page 35. Does anybody have any specific questions on those?
Any members got questions? No, we're all right with that. Thanks, Ian.
Thanks, Ian. So just to summarise points 24, 25 and 26. So the current forecast is approximately 3.5 million over the budget. It's almost entirely due to setting the performance fee lower than we'd expected. So we've seen high performance within the fund. We'd expect to see performance fees increase as a result. It's important to note that over 90% of the budget is spent on investment manager related expenses. So given that most investment manager expenses are based on a percentage of assets under management, any increase in asset values will result in higher absolute management fees. Also important to note that the costs can be volatile, and we've seen in previous years that where we've had a large decrease in the stock market returns, we've seen nil returns, and therefore that performance fee can be highly volatile as a result. Any questions from anyone?
Yeah.
Sure.
No.
These performance fees, if fund managers do particularly well one year and then particularly badly the year after, so that on average over 2 years they are average, do they still keep the performance fee for the first year?
We'd have to look into each agreement in total, but we have things like clawback in place, so they're not in every case, but in some cases. But good question.
Thanks, Nick. So that concludes the report by Bulesh and Ian. We have no further questions. I don't know. Nobody offline wants to ask a question. So we are simply asked, we asked to note the business plan and latest monitoring position against the pension fund budget for 21-22. Is everyone happy to do that? That's unanimous. The next item on the agenda is the risk management and internal controls. Chris Tambini, Director of Corporate Resources, is here to present this report as set out on pages 41 to 56. So over to you, Chris.
Thank you. I'm just thinking about the last report. Actually, I think it's the only example where the bigger the overspend, the happier I am, to be honest. So I was trying to think of another example. I can't think of another example, but
I suppose that means they're performing better, so the cost is more. Yeah, very unusual for you, Chris. Very unusual.
Long may the overspends continue. So this is the usual risk management update. It has been a fairly quiet period. There's been a reduction in a couple of the risks, and they're set out in paragraph 4. And I'm also pleased to report that internal audit have also reviewed the risk management process, and they're satisfied that it is working effectively, which is really good. The one difference of this report is we set out some details of an administration error that led to a write-off of a bit over £11,000. I mean, the errors within the pension fund are pretty kind of few and far between, to be honest, which is very pleasing. And I know Ian and his section are pretty meticulous in terms of the way they go about their work. So this doesn't happen very often. And also the process has been changed, so this can't happen again in the future, which is pleasing. And just to remind members of the size of the fund, there's about 95,000 members of the pension fund, about 30,000 kind of pensioners are being paid. So you need to look at this area in the context of just the size of the financial process and the number of people we do actually pay. So that's the only things I was really going to highlight by way of introduction.
Thanks very much, Chris. I think that's a fair comment. I saw the error, which is we've now put things in place to make sure it doesn't happen again. It's very unfortunate, but given the complexity and volume, it's almost inevitable at some stage a mistake would be made, and let's hope that it's only of this order of magnitude. Has any other member got any questions or items they'd like to issue on this? It seems a fairly straightforward report to me. Oh, Claire, please.
Thank you. In relation to the overpayment, and not really specifically about this overpayment itself, it's more about the process of approving the write-off. Obviously, you've talked to various bodies and people within the structure of the fund, but I was puzzled to think, well, what happens if one of them or more of them disagree on writing off or otherwise? So it was just to sort of clarify what the process and delegated authority is, who actually can approve the write-off if there is a disagreement.
Okay, so Chris.
To be honest, I can't remember there ever being a disagreement, but I think it's still me, isn't it? Yeah, I think I can just agree. But clearly, I do want to kind of get consensus with these things.
Yeah, I mean, I know Chris talked to me about it, and quite honestly, there really wasn't an awful lot of choice. But I do understand what you're saying, Claire. Yeah, and hopefully it won't happen again. Yeah. So, if we have no other questions, we're asked to agree to approve the risk register. Is that agreed? So that's unanimous. The next item is action agreed by the investment subcommittee and LGPS Central, an update. So, Bhulesh, over to you.
Thank you, Chair. So the purpose of this is to update the committee on 2 investments agreed by the subcommittee in July. These were namely the LGPS Central Private Debt Low Return Sleeve and Partners Multi-Asset Credit 6. So they both form part of the same asset class, and we delivered one report for that with Hyman's in attendance, and also a paper that accompanied it from Hyman's. So the proposal was a combined investment of up to 160 million into these 2 private debt products. We split them up. We then further approved 100 million to the LGPS Central Low Return Sleeve and 60 million to Partners, who are a long-standing investment manager who we've invested with previously. One of the bigger reasons for using Partners was that they were close to closing this product, and what we mean by closing is it's at its end of its investment. Collecting monies from investors, and therefore the money would be put to work earlier. The fund is underweight to this area, so it appealed in that respect. The second investment was an investment into LGPS Central's Core and Core Plus infrastructure sleeve. We proposed a £70 million investment, again accompanied by a Hyman's paper and an investment presentation from Central. There was a restriction on the Leicestershire Fund investing into this fund, so that we weren't more than 25% of the total fund. At the minute, Central don't have the relevant funds in investment from the other partner funds, so we've scaled back our investment slightly. So at the minute they do get the right level of investments from all the other partner funds, we'll top up to the 70 million. They were the two that we were going to update on. There's a little section here, points 15, 16, 17, regarding what we're looking to bring in future months to the committee for approval. So LGPS Central have a private equity 2021 vintage, which we will be bringing later. In addition, they also have a private debt high return sleeve, so different to the low return sleeve. This one targets a slightly higher return, and we've instructed Hyman's to commence due diligence for both, and we hope that we'll bring those to committee in November.
Okay, thanks very much, Bill. Has any member got any questions on it? It seems fairly straightforward report, and I'm familiar with it myself, being on the investment subcommittee. Yeah. So we're simply asked to note this report. So is everybody happy to note that report? Yeah, that's unanimous. Okay. The next item is investment subcommittee membership, which outlines what we want to do with that. If I could ask Kat Turi, Democratic Service Officer, to set out the report.
Thanks, Chair. This is a pretty standard report. It just sets out the membership of the subcommittee. So obviously we have the three Leicestershire reps of Mr. Barclay, Mr. Grimley, and then Mr. Gamble. The one member representing the City Council, which is Councillor Clark. The one member representing the district councils, which is Councillor Graham. And then Zubair, who represents the universities. And then also the three non-voting staff representatives tend to rotate. That's pretty much all I would say. One thing in the report, it does say it's not likely to meet often. In the past, it's probably met once or twice a year. It probably will meet more regularly because they want to have a bit more oversight of the managers and bring them in a bit more for some presentations. But other than that, that's pretty much all I would say on that.
Thank you. As Kat says, it is a fairly straightforward report, just outlining the membership of the group. Has anybody got any queries or questions on that? I can't think there would be. So we are simply asked to note this report. Is committee happy to do that? Everybody unanimous? Thank you, Kat. So the next item is the Picket Asset Management Market Update. We are joined by Andrew Cole, Chanel Runji, and Supriya Menon from Picket Asset Management, who will present on this item. So I'm
just getting.
Yes, Manish.
I ask a question just before we come in. Page 63, we say that Picket do not short models, basically.
Yeah, no, well, carry on, Manish. I mean, carry on. Yeah.
Page 71.
Yeah.
They do not take a long-term buy and hold thing. So if they do not short or they do not take a long-term view, what do they do? Or is it a better question to ask them?
I think that's probably a better question for them, but I do take your point. I very much take your point. I'm sure they'll be able to elucidate, perhaps before they start their presentation. Yeah, if you preclude everything, what do you do? Thanks. Yeah, perhaps we're being a little unkind, but could I ask you just to answer that to begin with, and then continue with your presentation, please?
Hello, good morning, everyone. Can you see and hear us all?
Yes, we can certainly see and hear you.
Okay. So you will see you've got the 3 investment team members situated together. Just as a brief introduction, so as you know, myself and Melissa, we work on the client team, and then we've got the portfolio managers for the dynamic asset allocation fund. So that includes Andrew Cole, who's head of multi-assets in London, and also Shanil Ramji, who's a senior investment manager within the team, as well as Supriya, who's a senior multi-asset strategist within the team as well. I can see you've got the presentation up, and thank you very much for inviting us today to present. So happy to, we've been guided in regards to the agenda, so we've got quite a condensed and focused presentation, appreciating you've given us 30 minutes and then 15 minutes for initial overview. Did you want to start off then with the initial Q&A to the team, and then they commence with the presentation?
Yes, I think that would be good. I mean, I think the first question was asked by Melise regarding you don't short and you don't take a long-term view, and I think probably picking those 2 bits out from the report, he just really wants an overview how you, or your modus operandi, and how you do your investments.
Okay, right. So let's think about the long-term view. We have a secular view about the long-run outlook for markets, but we recognise that markets don't provide returns in a linear fashion. Markets are indeed more volatile and predict many more booms and recessions than actually occur. And we seek to take advantage of that. So we don't sit with a static asset allocation based on a 5 or 10 year expected view for the returns of markets, because actually markets are much more volatile, and we want to use that volatility and the overvaluation and undervaluation in markets that occurs through time to our advantage. With regards to the no shorting, we don't utilise leverage in the portfolio. We are long only being the fact that we will only own assets. We will not take a view on shorting an asset on the basis that we think it is overvalued, that we are going to borrow that asset to sell it short. So we don't run a relative value strategies within our portfolio. Our belief is that it allows us to have better risk management if we keep our portfolio relatively simple, with easily understood building blocks, seek effective diversification within the assets that we own. Does that clarify? Is that?
Yes, that does clarify.
Thank you very much.
Okay.
Thank you for answering that. So if I could just ask you now to continue with the presentation, and what we've allocated a maximum of 30 minutes. So if we could carry on, that would be great.
Okay, so look, you've asked us to firstly address a performance, and firstly I would like to thank you for your ongoing support. The value of your portfolio with us at the end of August on page 2 of the presentation shows that was a little over £151 million. That in terms of performance, year to date up to the end of August, we have a return of 7.88%. That on a 12-month basis comes through at 14.23. On the year to date, 1, 3 and 5 years, and indeed since your initial investment with us, we have exceeded the investment objective, which is cash plus 4%. So we don't sit on our laurels, and our task is to harvest returns as and when they're available, but we are at least keeping ahead of the investment objective. We were asked to address the macroeconomic outlook and the outlook for markets. Slide 3, we provide our GDP and inflation forecasts for countries and regions around the world, and that provides the backdrop for markets over the next 1-2 years. And with regards to economic growth, our expectations are that for most parts of the world, economic growth is going to be above long-term trend. And indeed, our expectations are slightly higher than the consensus, the view that everybody else takes. There are 1 or 2 exceptions to that, Japan and actually the United Kingdom. The right-hand side shows inflation forecasts, and here we similarly have slightly higher expectations for inflation over the near term. Once again, most notably in the UK. But our general backdrop here is that this inflation is transitory, and that's a phrase often used by central banks. And we think it is in response to the disruptions and the lack of inventory and the shortage and the disruptions to trade that the COVID pandemic has presented with us over the last 18 months. And the UK is particularly vulnerable to this, and in part, Brexit and trade issues there haven't helped. But in the fullness of time, we expect inventories to be rebuilt, shortages in the supply chain to disappear, and those inflationary pressures to dissipate, and so we will see inflation generally come back to more normal levels. With regards to monetary policy and what are central banks doing, we think this backdrop means that interest rates are going to remain low. Central banks, by and large, are going to remain pretty accommodative. Governments continue to think, we've seen some fiscal tightening in the UK, but overall, governments and central banks still want to promote growth. They want to ensure that the economies are on a sound enough footing, that we see income growth, that the economy is able to deleverage. And even in the United States, the central bank is saying that they want to see strong enough growth that all elements of society see the prospects of wage gains and income growth. So we think central banks are going to let economies continue to grow, and that we are at the beginning of probably what is once again quite a long economic cycle. In terms of the prospects for markets, if we can turn to slide 4, the top chart shows the returns from global equities and how that is made up each year. The dark blue often sits right in the middle, is the return associated with the dividend yield. The slightly dark, well, the mid blue colour is the contribution to return that comes from earnings, the growth in corporate profits. And the light blue is the element about the valuation change of the market. What are people prepared to pay for that earnings? And you will see that for 2021, we've seen the inverse of 2020. We've seen a recovery in economic activity, a sharp rebound in corporate profits, a recovery and growth in corporate profits, and that has been offset by a contraction in the valuation. 2020 was corporate profits fell, but the market was prepared to pay a higher price for those future gains. And so to some extent, those 2 years, it's not unusual that we should see that sort of flip and rotation. And indeed, we've indicated at the start of this year that that's exactly what we should expect. The chart on the bottom shows our expectations, our leading indicator for economic activity, and how that impacts corporate profits growth. So the dark line is our leading indicator. The grey line is the 12-month change in corporate profits, and the grey dot is where the consensus sees corporate profits growth over the next 12 months. And we would argue, given where our leading indicator is, there still remains a positive surprise to come from corporate profits. So that bodes well that when we start to think about 2022, the mid-blue line should be up, and what we have to worry about is any further contraction in the valuation, which leads us to think about interest rates and the impact that they might have on the valuation. Slide 5 focuses on that aspect to some extent, and the role of inflation. The top chart is the United States. The bottom chart is the United Kingdom. You want to focus on the sort of peacock colour line. That is the year-on-year inflation rate as it is today. And you will see that both in the UK and in the United States, we've seen a meaningful increase. You will also see that the red line, which is the market's pricing of inflation over the next 10 years, has also risen. And that's not unusual. When we see a rise in the one-year inflation rate, the market often thinks that this is going to be persistent and demands a higher premium for inflation over the longer run. So, if the market was worried about long-run inflation, it's already priced for that, because in both instances, you'll see that the red line is above the long-term average, which is the dark dotted line. The light grey line is the yield on offer on inflation-linked securities. What is the risk-free rate? And you will notice that both in the United States and in the UK, that since the 2009 type era, that has been negative. What that means is that investors owning bonds, wanting to ensure that they get some inflation protection, will in fact actually get poorer in real terms. They're paying a price for that. And so we see that the real rate is negative. We describe this as being financial repression. It means that holders of bonds will receive a return that is below the rate of inflation. We think that supports other assets, and it means the investors are generally looking for positive real returns. Slide 6 just shows the relationship on the left-hand side between bonds and equities, and the correlation. To what extent do we get some diversification from having a portfolio that has both bonds and equities? And you'll see that this moves around markedly, and that it also has implications and is affected by the rate of inflation. And so when we have inflation higher than average, what we tend to find is that bonds and equities become more positively correlated. And that's means that the diversification of having bonds becomes less significant. The chart on the right-hand side of the page shows how stocks behave relative to one another, and we're using the US S&P 500 here. And you will see that as of today, actually, stocks are doing their own thing. There is one stock's performance is less driven by the next stock. And what this indicates to us that there is value to be added from owning the right stocks, from having an active stock selection process being focused on the right areas of the market rather than owning the market in general.
If we move on to page 7, having been asked to describe some of our process around climate change and how we incorporate that into our assessment of the macroeconomy and indeed asset markets, I thought it would be important to just give a little bit of background about how we think about climate change and ESG in general. Importantly, we believe it's more than a set of just a set of exclusions. While we do exclude, and we can discuss that further should you wish to, we think there's a mindset around incorporating these factors into our investment process, and we follow what we call an integrated process, in that it's embedded in the way we do research, in how we think about our tactical asset allocation, and finally how we implement the portfolio. So we think about it throughout our chain of investments, and importantly report to you exactly what your exposures are, and making sure that we not only understand the exposures, you understand the exposures, but we also comply with several regulations. Now, at the moment, the Europeans are quite further ahead of us in terms of defining what those regulations are. So we've decided to go along with those European regulations until we get better information from the FCA. However, we do know that it's going to be quite complementary with the European directives. And we've just got on this page a little bit about those should you wish to read more. What's important to note is that the fund is in a position now to apply formally for what is known as Article 8, and that designation would confer a full recognition that the fund is an ESG integrated strategy. So on page 8, I think is interesting to think about how we incorporate climate change into our overall thinking about markets and macro. And importantly, why is it become so important today? Now, we do know that the effects of climate change are becoming more visible. The information that we know about about how climate change is affecting the economies is more clear. But importantly, the state of the asset markets make us more concerned. And that is because, in effect, because bonds have yields that are much lower today and equities have valuations that are much higher today, we need to have a much longer payback period when we get returns from these assets. Now, that payback period having been extended means that we have to incorporate risks that are further into the future. And that now really includes climate change. So by including climate change, we're just trying to think about, are we getting paid for the risk we're taking in these assets? Here on page 8, we've just have a brief outline of how we think of each asset class and how climate change may affect them. And I'll just focus on 1 or 2. So for example, government bonds, we do need to think about how governments respond to climate change, how the fiscal situation will impact them, how much they will have to spend to alleviate some of the effects on climate change. For example, in equity markets, we do have to think about the different sectors that will be how the implication on different sectors will evolve over time, and what that would do to what investors are willing to pay. But also the important point is that, in fact, equity markets will probably incorporate some of these risks much more faster than, let's say, the corporate credit market, where we see yields not really responding as much as equities to climate change, because the need for yield and the desire for yield will really trump investors' preferences. So it's a very complicated subject, but we have to think about it across the capital structure and in a very nuanced way for each asset class. On page 9, we are giving an example of what we call physical climate change. Now, of course, physical climate change is something that we can touch and feel, essentially, and rising sea levels is one of those that we pay attention to. And why do we care about rising sea levels? Well, for example, if we own properties or if our companies own infrastructure that is in worse affected areas, this will start to discount what that infrastructure is worth or what those properties are worth. So if we're looking at 10, 20, 30 years down the line, and we're paying for earnings in that on that timeline, we need to know whether that building, that piece of infrastructure, or indeed that company's business model will be affected by these long-term physical climate-related changes. So we have data, for example, that will allow us to understand the better placed geographical areas and indeed the worst placed geographical areas. On page 10, we are looking at ways to build in transition risk into the portfolio, or indeed transition opportunities. So within the portfolio, we have an exposure to a strategy that will take advantage of some of the transition effects of climate change. How will we, on page 10, how will we, as an economy, start to improve the climate the climate defensiveness of many of our companies? So in effect, is it the water supply? Is it pollution? Is it how we are more efficient in terms of using energy? So we do know that there's a lot of fiscal spend from governments going into climate investing, and we want to take advantage of that. So that transition opportunity is already embedded in the strategy. And as you can see on the bottom right-hand chart, since we've inputted that strategy within the fund, it's vastly outperformed global equities. So that trend of better earnings from these companies, given these long-term pressures and long-term allocation of capital, is really shown on that page. Now I'm going to pass on to Supriya, who will talk more about how we measure the carbon indicators.
Thank you, Shanil. And as Shanil gave you an overview of some of the macro implications of climate change, both physical risk and transition, as well as how we expose ourselves to opportunities, equally, it's important for us to monitor these risks on a granular level in our portfolios and be able to share that information with you. So here's an illustration of direct emissions. We monitor carbon intensity on page 11. We monitor carbon intensity through direct emissions. We've shown that to you on the left-hand side of that page. It's tracked across equity and credit positions. We are in a position to also track that through time, as we show on the bottom right corner of that page. And while we start out as having a better footprint than that of a broad equity index, that's also falling through time. And we share this with you also in our responsible investment booklet, which you should be receiving on a quarterly basis. But equally, if you did want that, the latest one, we're happy to send that to you. The right top corner shows you a chart on potential emissions. That's the emissions that could emerge from basically the proven or probable reserves of fossil fuel companies. And on that note, we do provide more granular detail of our exposure to companies with significant fossil fuel revenues on page 27. So happy to go through that if you so require. Let me pass you back to Shanil.
On page 12, we outline our portfolio strategy, and I think it will ring true to a lot of the points that we've made today. In general, on asset allocation, we do think that's page 12. On asset allocation, we do think that real returns are incredibly important in this phase of the cycle, and choosing the right equities to express that is going to be very important. So we do think that real returns is what we're going to build into the portfolio currently and continue to do so. The dispersion between equities is going to be large. So having good selection in where to take advantage of those real returns is going to be important. Secular winners, so that's the long-term winners, continue to feature in the portfolio, and they have strong earnings potential. Having been quite defensive through the summer, using areas that have strong cash generation, such as regions such as Switzerland or sectors such as healthcare, has benefited the portfolio well and has kept the portfolio reasonably stable, continuously building return through the summer. However, as Andrew mentioned, we are looking for cyclical resurgence now. So tactically, we're looking for opportunities to increase the cyclicality of the portfolio, and that will generally come from Asia, which has been fraught with the Delta variant and is now resurging from that, making supply chains much more open and increasing the growth potential of the global economy. Risk management is critically important in this fund, so we always think about what's going to drive risk. Government policy does have an outsized impact today, given where government intervention is. So we do have to think about that. As Andrew mentioned, bonds are no longer the panacea for risk management. We can use them sometimes, but not always. That's why using instruments such as optionality do help us build a more asymmetric portfolio, protecting the portfolio against steep drops and sharp drops. And importantly, in encompassing real returns into the portfolio, commodities do play a part, and indeed this year have been a very strong contributor to returns. So in the trying to make sure that we have time to answer all your questions, we'll leave it there for the presentation and leave it to you for Q&A.
Okay, thank you very much. So, members, has anybody got any questions on the presentation? No, I think it was foolish.
Can I ask a quick question on? I think it was slide 11. Kat, you want to just go back on? Yeah, yes. Those two graphs on the top, direct emissions, we can't quite read what the benchmarks are. It's a bit small at least on my screen anyway. But can you explain what you've done in particular to achieve such big decreases versus those benchmarks?
Yeah, so the benchmark used here it just refers to a broad equity index. So that's what it is MSCI AC World specifically. But in terms of how we've reduced our exposure, so we started with a fundamental belief that we are in a situation where the world is moving towards a lower carbon economy. So we want to expose ourselves to sectors and companies and segments that are poised to benefit from that, and to reduce exposure to less carbon intensive segments. So we've tended to have, you can see on page 27, that will also tell you, here it's not compared to the broad equity index, but we have very low exposure to companies with significant fossil fuel revenues, and we've tended to be cognizant of that ourselves, to make efforts to reduce those exposures in the portfolio through time. So tracking it, monitoring it, and including those, these metrics and others and these considerations in our portfolio construction process is how we do it. And I just want to mention also that this is not just on a granular level, this is also from the top down. We have a process, and we call it a working group within our main asset allocation process, where we develop themes that are, ESG specific themes. And one of the major themes there is a low carbon transition, as well as physical risks of climate change. So we really start from the top down, understand the theme, understand its implications on the market, and then aim to reflect that in our portfolio. So it's very deliberate on our part.
Thank you very much. So have we got any other questions? I don't think we have. Well, thank you all for your attendance and a very informative presentation. Thank you very much. Thank you.
Thank you very much.
Thank you, and thank you for your ongoing support.
Thank you very much.
Right, so the next item is the summary valuation of the pension fund investment. We've spent quite a bit of time on this. This is a midterm valuation. So Declan, over to you.
Thank you, Chair. So this is the standard quarterly report that just picks up the fund's investment performance. So I'll only pick out the sort of the main points. So just picking off, starting with paragraph 2, you'll see sort of the wider market return. So this isn't the funds, this is just sort of the markets in general. And you can see from there pretty much all signs that the impact of the pandemic have been pretty much erased now from the kind of the performance figures, which is sort of truly remarkable. And you'll notice for equities, between the sort of listed and the private, which does make up the majority of the fund's investment, that we are now at the stage that the 5-year returns are indeed exceeding the 10-year returns. And you could see that as a sort of a signal that there could be sort of a market correction, which a lot of commentators are saying is coming. They just don't know when it could be coming, which is always the sort of the devil with this. And that's why I sort of say could be a sort of a sign of a correction. And Hymans do, when they took through the analysis, their 5,000 scenarios, that does include a sort of accounting for these potential corrections in the valuation. But I suppose just the reason I raise it is it wouldn't be a surprise between now and the valuation date to see a tail off in equities, hence that sort of 100% level that was being talked about before dropping away a bit, but still better, I think, than what we had in the previous valuation, but just to sort of try and set expectations a little bit. And the next section I was going to pick up was on paragraph 5, which just picks up the main changes over the last quarter in the sort of where the assets have been invested. And the biggest was the launch of the multi-asset credit fund. And because this was a cash transition, it was a pretty straightforward transfer. It was just basically a sell out of some manager and a buy into others, as opposed to trying to move with the market. So that went okay. And a handful of property transactions there. It's closing the gap to where our target allocation is, but there's still quite a bit underweight. Next section I was going to pick up, if you go down to sort of about paragraph 18, and it just shows the performance over of the fund over sort of the last quarter, year, 3 and 5 years, and you'll see that the long-term performance is pretty much there on benchmark. And for the active managers, we do aim for them to be above benchmark. So there is a sort of a tinge of disappointment there, although obviously it's better to be in line rather than below. So the reason why we haven't sort of been exceeding the benchmark is kind of, there's three main factors, a few other bits and pieces, but the first one is Central's global active product, and it has a balance between growth and value managers in there. But the problem is when the market is consistently biased to one of those factors, as it has been towards growth and away from value over the last few years, it does mean that the value manager struggles. Hence, you do tend to struggle to have that overperformance. And that does link to the sort of the second reason as well. The fund was heavily biased to sort of the value sort of side of the world a few years ago, and we have gradually unwound that to be a little bit more balanced. So there is still a bit of an overhang from those sort of very historic decisions where we would have more of that value bias. And the third one I want to pick out, which I'll come back to in a bit more detail, is the sort of distressed debt investment, which is behind, but the report picks that up later, so I'll come back to that in a second. So that's talking about sort of the benchmark, i.e. where the sort of the broader sort of markets have performed. But the other sort of key figure that you heard about earlier from Hymans is what is our target within the valuation, and that's actually set at a lower level. It can be quite independent from where the markets perform, and it's a fixed amount effectively. And that was the 4.5% was the figure you heard to get to 100% funded. So you'll see why the funding basis has improved so much, because we've exceeded that kind of consistently over the last few years. Just picking back up in the next section of the report goes into the investment funds. I won't go through, there's quite a bit of detail there. I'll let members sort of sure have read it themselves already, but just wanted to pick up paragraph 55, where it does pick up the distressed debt, and it's M&G is the manager that we employ to do that. And you'll see that the performance there is compared to Partners Group, and the Partners Group it tends to be primarily secured debt, where the distressed debt by its nature is right at the sort of the risky end of the market. So it is disappointing that the M&G have actually performed below Partners. And it's kind of ideally for something like M&G, you want to be getting sort of more around the sort of the 10% return, never mind the kind of where they have ended up. And the point I wanted to pull out here is the fund has made a decision, I suppose, to dabble in occasionally kind of higher risk sectors, and we've got kind of 4 of them really. We've got the kind of the private equity secondaries, which has done well for us, and indeed we've sort of done follow-up investments. We've got the CRC, the Christopherson Robb sort of bank leverage thing, which again has done really well, and we'll have a look at doing a bit more later in the year. Infra capital is sort of greenfield infrastructure, sort of as opposed to so by that you mean kind of new build infrastructure as opposed to kind of acquiring existing sort of existing sites, which tends to be a bit more risky. And it's too early to say on that. They're sort of like 25, 30 year kind of time frame on them. So of the 4 we've had one that's probably in the sort of the doghouse a bit, 2 that's doing well, and one with a kind of a TBC over its head. So overall, that sort of strategy of taking on some higher risks is doing okay, but distress will probably as this unwinds, we'd probably have I suppose think twice about whether we went back into that or not. That's all I was going to say on the report. Happy to take any questions.
Thank you, Declan. Have members got any questions on that? No. So that's fine. So we are asked to note the report as committee. Happy to do that. Yeah, that's everybody. Thank you. So the next item on the agenda is fairly significant. It's a responsible investment quarterly report. Now, for this item, we have received representations from Climate Action Leicester and Leicestershire, and they've been circulated prior to the meeting, so all members are aware and can consider them. Climate Action Leicester and Leicestershire are unfortunately not able to be attended.
They're actually at the back. So.
Oh, they are. Right, that's good. That's good. So you are here. Right. With all you're watching on YouTube, but you're not. You're here in person. That's great. Thank you. I know that officers have been looking into the points set out within the paper. Boulesh, do you want to set out how you suggest the fund takes these views on board?
Thank you, Chair. So we've received the representation and the points raised in there. What we'd like to do is consider them in detail and bring back a more detailed proposal within the November committee, where we will have a climate risk report being delivered by LGPS Central, and we'll also have some updates for the stewardship plans that we have for the 8 companies which were identified at last year's climate risk report. So you can see the kind of improvements or the kind of engagement that's taken place at company level. So that's our plan currently for the representation received.
So to summarise, we will get a full report in November of actions and what we're doing and our strategy going ahead. Yeah. So have I got any questions from the committee? Adam.
Thank you, Chair, and thank you to Climate Action Leicester and Leicestershire for making this representation. I think it's really important that such representations do come from these reputable organisations. From my perspective, it's probably worth, just for context, that I declared Leicester's climate emergency in 2019 as the lead member responsible. It's my signature on the decision notice, and I do feel that we do need to, and I'm pleased to hear a report will be coming to the next meeting. I do feel that we need to be consistent as pension committees nationally within the LGPS to advocate for evidence-based strategic decarbonisation of investments based on the pathways that we know are being developed, as we heard earlier in training, and based on the declarations of climate emergencies that the majority of local authorities have made. That would be entirely consistent, and I think that is the only way that we can move forward, and I believe in any case that is the trajectory that we are embarking on. So this needs to be the basis to enable us to drive down emissions in line with those climate emergencies. And in fact, the national climate emergency that's been declared, climate and ecological emergency that's been declared. So I think there's 2 questions that I ask, and I think maybe we should ask as a committee. By when do we want pension funds to have achieved net zero by? And do we have the evidence-based map to achieve that? I think we expose ourselves to greater risk than we've noticed ourselves already if we don't ask those 2 questions. So I am concerned, but by not answering these questions, we're not doing our duty as committee members. I think it was 98 years ago that John Maynard Keynes said that in the long run, we are all dead. The long run's getting shorter, and so I do feel that it is time to act, Chair. Thank you.
Thank you, Adam. It's certainly an issue that we are taking very serious, and I think the points you make are valid. I think in the long term we're all dead, some of us sooner than others. But nevertheless, it is very much for future generations. I don't underestimate the importance of it, and I wouldn't try and decry anything you've said. But when we get the report back in November, I think that is a time for us to consider the issue very deeply, and also those questions that you've asked, because coordinating it among the various different pension contributors and everything else is not going to be straightforward.
I absolutely agree, but I think there is a role of advocacy that we have as members of the committee, rather than fund managers telling us what they feel. So I think as an advocacy role, I'm asking for here, Chair.
Pretty much in agreement with that, but every other committee, local pension committees throughout the country need to be doing exactly the same.
And some are further ahead than this one, Chair.
Okay, well, let's catch up then, and I'm sure we will. We have quite wide-ranging responsibilities in terms of meeting these sort of objectives that you talk about, and I can't disagree with it. We have work to do, and frankly, nationally, never mind locally, really the climate change issue is something which needs action nationally, because even leaving aside the local government pension scheme, there is so much more and so many other issues, and I'm not trying to put it to one side. We have to start somewhere, and taking action here is good, but we need a lot more action nationally.
Yeah, I think it's worth noting that in February it was announced there's £10 billion invested within local government pension schemes, I believe it is, and that's not an insignificant figure, Chair.
No,
it's in fossil fuels within local.
No, it isn't an insignificant figure, not at all. No, I'm not saying it is. Keith.
Thank you, Chair. 2 points from me, please. If the report that's been prepared for the November meeting could be shared with members at the earliest opportunity to give us a chance to really digest it, read it, and get to grips with it. And secondly, my colleague on the left, his passion is to be commended, but you've mentioned, Chair, I think we all need to do our bit, and this pension fund is, you could say it's one piece of a million-piece jigsaw, and I just wish that everybody would come to the party and so we can join the jigsaw pieces together. We are just one small part, although not such an insignificant part, and I just wish other countries around the world would take the same route that we are planning to take in this country. Thank you.
Thank you, Keith. And really, quite honestly, you put it better than I did, and that's really the point I was taking to make. But that doesn't absolve us to responsibility in this committee and in the pension fund. But we are a small part of it worldwide, but we still need to accept our responsibility, and we will do. And if we can have the climate change report, the report coming to the November meeting, once it's available, that would be helpful. All right, so thank you for the representatives from Climate Action Leicester and Leicester for attending this meeting, and perhaps you'd like to come in November as well. Nick.
Just like to add is that a lot of members of the fund who are in their 20s and 30s and are reliant upon their pensions paying them in 50, 60, 70 years' time. So this is very important to them, whereas if you're in your 90s, you're not that fussed, maybe.
Yeah, I understand what you're saying. It is, of course, it's important to 20, 30-year-olds, and it is actually important to us. So no matter what your age is, you know what really it is an issue that we need to address. And in honesty, I do think we are making strides towards addressing it. Now, it may not be to the level that everybody desires, but we can't achieve it just by flicking a switch. It does need concerted effort over a long time.
Yeah, thank you, Chair. I agree, it needs effort over a long time, and what works, not just making statements, but actually practical things that make a difference.
Yeah, I would very much endorse that. It isn't just a question of making statements, it's actually positive action that makes a difference over the long term, with a view to achieving what we want to achieve as globally and nationally. But look, we will have the report back in November. Has anybody else got anything else they'd like to say?
And then report.
Yeah, Claire. Claire.
Thank you, Chair. I just thought a couple of observations might be helpful in terms of in terms of the issue. It's absolutely critical in terms of managing the risks associated with the investments and the returns. I would emphasise this sort of balance of cost point in terms of if the investments don't deliver, whether it because of risks associated with climate change, the burden of that falls on the employers in the fund. Largely the members' benefits are guaranteed. I think I can't emphasise how difficult this is. I think it's getting much more focus in the investment industry, and things are getting better. But the data around fossil fuel and greenhouse gas emissions, etc., is getting much better, but it's not perfect. So I think a lot of investors are struggling. What's the best way to take action while protecting investment returns, etc. So it's not difficult. And finally, I would just emphasise, irrespective of what goes on in other pension funds, I would emphasise that the committee's duty is as is. It's irrespective of what everybody else is doing. The decision has to be yours in terms of that duty to the members, employers, and taxpayers. So it really should be an investment decision for the committee rather than what everybody else is doing. Thank you.
Thank you, Claire. Good point. We still have a responsibility to provide returns to our investors, but that I very much take all your points on board and noted. I think we all have an interest in climate change, genuine interest, and I personally do as well. Bulesh, could I ask you to take us through the? Oh, sorry, Adam.
So yeah, I mean, I couldn't disagree with what Claire said, and if I just go back to what I said and maybe state it much more succinctly, what I've asked for or suggested is an evidence-based roadmap to decarbonisation, which would be fair, I guess, equitable, and obviously mitigated those risks that Claire's alluded to herself around returns on investment. I think that's what we need to do, but it also needs to be consistent, particularly as elected members around this table, with what we have said in other forums, because we also we would be inconsistent if we weren't pushing those same buttons.
Thank you, Adam. I accept what you're saying, and we will work on it. I think we all take it very, very seriously, all the responsibilities, and I think the point Claire made is valid. We have multiple responsibilities, and this is one of them. Bulesh, if I can ask you to go through the report.
Thank you, Chair. So the purpose of the report is to take us through the RI plan for 2021. We've also got an update, which is also for the quarterly voting report, Appendix A, and the quarterly stewardship report written by LGPS Central, included in Appendix B. There's a little bit in the background section we just want to cover on. The fund first reported on climate-related disclosures in line with the recommendations from the Task Force on Climate Financial Disclosures, TCFD. That was completed earlier in 2021 and presented to the committee. The TCFD guidance aims to improve transparency by companies, asset managers, asset owners. What we'll find in the future is that there'll be measures included, and not just defining what the measures are, but what the targets need to be. And these kind of things have become more common in the future. Point 7 there is just picking up on the stewardship plan, which was delivered in 2021, and it included 9 companies which the fund has exposure to that face a high level of climate risk. We talked about those earlier. 8 of those are covered by Climate Action 100 and their engagement project. So we attack those on 2 fronts, not only just with our holdings, but also combined holdings that Climate Action 100 can use as well. Point 8 on page 110 is looking at the 4 stewardship themes that LGPS Central cover now, and these stewardship themes cover a 3-year period. And the reason that it is a 3-year period is you need a certain amount of time to kind of engage companies and enact change. So we've kept with the same 4 themes. So those 4 themes are climate change first, plastics and single-use plastics, fair tax and tax transparency, and the fourth is technology and disruptive industries. And we chose to keep those in line, having not wanted to change those just because of the kind of traction you'd lose in changing any of those. The section there from points 9 to 13 talks about the quarterly voting report. We're trying to cover more and more of our funds holdings, and you'll note there that 46% of our funds holdings are covered in the report in Appendix A. So that covers mainly all our equity funds. It can't cover certain things like commodity futures, currency forwards, derivatives, debt, property and cash, for example, which make up nearly 25% of our fund, but we're trying to capture as much as we can. The report in Appendix A does give you how many meetings were voted out, what kind of resolutions are voted against, etc., but we won't go through each of those in total. Points 14 to 21 talk about the quarterly stewards report, and then there's a link there if you haven't seen it, but you can also use that link to find the previous reports. They take you back to LGPS Central's website. Point 17, I just want to quickly pick up on that. LGPS Central co-signed a letter to the COP26 president asking for support to investors by seeking publication of the underlying assumptions tied to a 1.5 degree scenario. I suppose the idea here is that knowing these assumptions, you can then compare to company plans and hold them more to account. It'd be good to see those, and then we can, LGPS Central along with their engagement partners can use that to further press on engagement. Point 19, probably worth talking about, is a positive engagement story. It doesn't name the company, but many will probably know it already. And I suppose the point here is holding shares rather than divesting those shares has led to this kind of engagement and the outcomes. A similar story did the rounds earlier in summer for Exxon, which you may or may not be aware of. So a small activist shareholder, small holding, managed to put 3 directors on the board to enact climate-friendly practices and change the strategy. I don't think I've got much else to say other than we're bringing the climate risk report to the next committee. We've talked about it previously, and we'll also update on the developments on the 9 companies which were identified at the last climate risk report last year. Any questions?
Thanks, Bulash. It's good to hear the work that is going on and will continue to go on. And we'll wait for the report in November. Has anybody got any questions? Adam?
Yeah, it's not a question, it's a statement really, in that I've been reassured, partly reassured, as you'll have noted from my previous comments, but I have been very reassured by the work that does go on and the attention that is paid to responsible investment, both in this committee, but obviously outside in the wider work of the fund officers here, LGPS nationally. There is clearly great attention being paid to these matters. I think it's how we address these matters, not whether we're addressing these matters, that is something that I'm trying to up the debate on.
Yep. Thank you, Adam. And you're right. There is huge attention being paid to this, but it's getting the report in November, seeing what we're doing, seeing how we can quantitatively and qualitatively measure what the achievements we're making. And I think Bulash made the point, we can actually have quite a lot of influence on companies and their actions, more so than probably I realised initially. But yeah. We take it seriously and we will continue to focus on it in this committee. So if there are no other questions or comments, we are asked to note the report. Is the committee happy to do that? Right, that's unanimous. Thank you. Item 14, any other items which the chairman has decided to take as urgent? There are no urgent items. We have future dates of the meetings are listed. And members should also note the Leicester Pension Fund's annual general meeting will be scheduled for the 13th of December 2021 at 12 noon. Now we're just going to go into private session. So I move that in accordance with the Local Government Act 1972, the public be excluded from the meeting for the remaining items of business on the grounds that they involve the likely disclosure of exempt information. So thank you for the representatives coming today. Nice to see you here, and I hope you come back in November.